Thank you everyone for joining us. We're really excited. I'm Gary Lipsky, president of Break of Day Capital. We also have Kyle Mitchell, managing partner of Limitless Estates, and Brandon Hall, CEO and founder of the Real Estate CPA. We're going to have a lot of great information to share with you guys tonight. We're really excited, and without further ado, let's jump into tax benefits of investing in real estate syndicates. Brandon, you want to take it away?
Sure thing. So thanks everybody for attending. What we're going to cover today is, you see right here on your screen, we've got the passive activity loss rules and limitations, cost segregation studies, 100% bonus depreciation, the 20% pass-through deduction, and investing via retirement accounts. So we're going to be really hitting on you as a limited partner investing in syndications, how you can understand these rules better, ask better questions of the deal sponsors of the syndicates that you're investing in, to better understand how your investment will affect you from a tax perspective come tax time. We can jump to the next slide. All right, so the first things first is we have to understand what the passive activity loss rules are. Whenever you invest in real estate, you're investing in passive income. So the rental real estate that you purchase, small or large, is going to produce passive income, and that passive income can be offset by passive losses. The question becomes, though, if I have passive losses in excess of my passive income, what happens at that point? So many of our clients, for example, they'll buy a rental property, they will cash flow $5,000, but their net taxable loss might be $3,000. And the big accelerant there is what we call depreciation. So if I have $5,000 of operating income and then I have depreciation of $8,000, my net taxable income is actually a loss of $3,000, even though I've pocketed $5K. And I get to tell the IRS that I lost $3,000 on my rental activity, even though, again, I pocketed $5K. When you build your rental portfolio, the losses tend to get bigger and bigger and bigger. And then what we have is the passive activity loss rules. So we have to understand whether or not we can even take the losses as we build our real estate portfolio out. So if your modified adjusted gross income, and it's called MAGI, but just for your sake, just think of like W-2 income or business income. If your W-2 income or business income is $100,000 or less, you can claim up to $25,000 of the passive losses that you generate. No questions asked. So again, going back to my rental scenario, let's say I do have that $3,000 loss. As long as my modified adjusted gross income, my MAGI, is below $100,000, I can take that $3,000 loss against any of my other ordinary income. But as my modified adjusted gross income increases above $100,000, I get phased out of being able to take that $25K loss allowance. I get phased out of being able to take that every $2 that my MAGI increases. I get phased out $1. So you have a $25,000 loss allowance that you can use. No questions asked. I can generate $25K of real estate losses, passive losses, and take that against my income as long as my MAGI is below 100K. But again, as I increase above 100K, I begin to be phased out. And since I am phased out I'm phased out for $1 for every $2 that my MAGI increases above 100. When my MAGI hits 150, I've been phased out of $25,000 of losses. Therefore, or that's where we're kind of like backing into this $25,000 amount. And this is an important distinction to understand, because when you're investing in syndications, as we'll talk about in a little bit, you need to understand where your MAGI is and how the passive losses that the potential syndication can be utilized by yourself. So if I invest in a syndication and they run a cost seg and they do 100% bonus depreciation and I get this big passive loss, can I take it? The first thing that you look at are these passive activity loss rules. If your MAGI is below $100,000, you can take up to $25K. If your MAGI is above $150K, like most of our clients that are investing in syndicates are, then you cannot take your passive losses. So go ahead and jump to the next slide. So if your MAGI is above 150K, we have suspended passive losses. Now, what'll happen is, let's go back to that $3,000 loss scenario. And let's say that my modified adjusted gross income is indeed above $150,000. That $3,000 of loss is going to be considered suspended. That means that I cannot utilize it against my current income, my ordinary income, earned income, W-2, business, whatever other income I have. That $3,000 loss is suspended. It then sits on my books, my tax returns, year after year after year, indefinitely. There's no time limit on it until I create passive income to tap into those suspended passive losses, or until I liquidate that property that created those suspended passive losses, or another property with a gain. So just understand that if you can't use the suspended passive, if you can't use the passive loss, it will become suspended, but it's not all lost. It's still sitting there on your tax returns. You can utilize it in the future if you produce either gain from the sale of a rental, or if you produce passive income. A lot of our clients start looking at PIGs, that's called passive income generators, so PIGs for short. And that can be like real estate activities that are already producing income, certain businesses that produce passive income for the investors in the business. And they'll invest in these PIGs to specifically offset the huge amounts of suspended passive losses that they have sitting on their tax returns. Now, suspended passive losses, aside from being able to utilize them at some point in the future, they're not totally a bad thing. And I like to remind clients of this. The reason they're not totally a bad thing is because they provide you with flexibility at some later point. So for example, let's say that I have a rental property that I am considering selling. It's top of the market. I think that I've got some really solid appreciation built in. The fair market value is not going to increase much more. So I'm going to go ahead and liquidate. And let's just say that I have $150,000 of capital gain and depreciation recapture built into that rental. Now, when I go to, excuse me, when I go to sell it, I have to pay tax on that 150K of gain and depreciation recapture. And most people will automatically default to doing a 1031 exchange, right? If you Google, how do I avoid tax on the sale of my rental property, 1031 exchanges are probably literally the first thing that pop up. And that's what everybody defaults to. But they fail to kind of take a deeper look at their tax return and understand, what are my suspended passive losses? Every once in a while, we'll get a new client in the door that'll be saying, yeah, I want to liquidate one of my properties and I've got this gain and I've already got the 1031 intermediary all lined up. And we'll take a look at the tax return and say, hey, you have this $150,000 capital gain here, but you also have $120,000 worth of suspended passive losses from all of your rental activities, all of your rentals put together, your entire portfolio. And that means that you could liquidate this rental right now. You would owe the net $30,000 of gain. You would owe tax on that. But the suspended passive losses that you've accumulated over the years do allow you the flexibility of just pulling the trigger and liquidating, rather than going through the hassles of a 1031 exchange. And 1031 exchanges, as you continue 1031ing year after year after year after year, what happens is you have something that I kind of refer to as basis erosion. So I start off with a 100K property, then I 1031 into a 200K property, but my 100K basis is still in that 200K property. I don't get a 200K basis. So now I've got a $200,000 property producing depreciation that a $100,000 property should be producing because of that basis. You keep going and going and going, you might end up with $1 million property producing cash flow like $1 million property should, but the basis in the property is still really low, $100,000, $200,000 probably by that point. So that's what I refer to as basis erosion. But if you're able to just liquidate the property because you have suspended passive losses already built up, then all of that goes away. Then if I purchase $1 million property, I have $1 million worth of basis. I'm not doing a 1031 exchange, and that's why that works. All right, next slide. I think I hit that one pretty good. All right, so cost segregation study. So if we're starting to put all this together, right, we've talked about the passive loss rules. We've talked about suspended passive losses. Now we're going to talk about how do syndications generate large passive losses for their limited partners. The first thing that most syndicates do is they're going to run a cost segregation study. And a cost segregation study is the practice of allocating value to all of the property's components. And the purpose there is to accelerate depreciation, which is ultimately going to result in a higher first year depreciation expense or early year depreciation expense if we elect out of 100% bonus depreciation, which we'll talk about next. So a cost segregation study, if I buy $1 million property, the whole purpose of a cost segregation study is to go into that $1 million property, walk around, detail all the different components that make up the property, right? What are all the personal property components, such as appliances, carpeting? What does the electrical look like? Plumbing? What about fixtures? Any sort of furniture that's already in it, cabinetry, anything that is in the property we want to identify, and then we want to assign a value to. That's what a cost segregation study does. Now, on a multifamily property, typically 20 to 30% of the purchase price is going to be allocated to 5, 7, and 15-year property. And that's really important for bonus depreciation, as we'll find out on the next slide. And then I have an example to kind of walk you guys through. But what we want to do, so with a cost seg study, if I buy $1 million property, I can count on $200,000 to $300,000 worth of that property being allocated to components with a 5, 7, and 15-year life. Now, the downsides of a cost seg study is that they are expensive to administer. So you do have to hire a cost segregation firm. They will fly somebody out to the property. But the benefits are that you get really large depreciation expenses, either in the first year, if you do a 100% bonus depreciation, as we'll find out in a second, or if you opt out of 100% bonus, you can still increase that depreciation expense the first 5 to 7 years. And just to kind of illustrate the difference, if we were to boil it down on like a $100,000 property, on a $100,000 property, my annual depreciation expense might be about $4,000 bucks. But if I run a cost seg study, I can either take bonus on probably $20,000 worth of the value in the first year, meaning that my depreciation expense year number 1 is going to be $20,000, or I can just take 5-year, 7-year, and 15-year depreciation. I can opt out of 100% bonus depreciation. And as a result, my first year through the 5th year depreciation expense might be somewhere around the $15,000 mark. But if we jump to the next slide, I'll explain bonus depreciation. And this is kind of really where you, as a limited partner in syndicates, get a lot of benefit. And it's something that you need to understand how to best utilize. So 100% bonus depreciation allows for the immediate expensing of property components with a useful life of less than 20 years. Oh, sorry, do you mind jumping to the next slide? There we go, thanks. So it allows for immediate expensing of property components with a useful life of less than 20 years. So again, we do a cost seg study. We allocate 20 to 30% of the value to components with a useful life of 5, 7, and 15 years. So if we can do that, then the bonus depreciation rules allow us to immediately expense all the 5, 7, and 15-year property if we opt into it. And this has increased from 50% to 100% thanks to the Tax Cuts and Jobs Act, which is why you're probably seeing a lot more information about it, because it's become a lot more advantageous to start using these bonus depreciation rules. So if we invest in a $10 million property, that last bullet point there, if we invest in a $10 million property, we're looking at a $2 to $3 million first year depreciation expense, thanks to 100% bonus depreciation. And that's important to understand, because as a limited partner, jumping back to the whole passive loss limitations, I can only take $25,000 of passive losses unless I qualify as a real estate professional, right? Or if my MAGI is above 150K, I can't take any passive losses at all. I get totally phased out. But I can take passive losses against passive income. And if I have a rental property that I'm selling that's going to sell for a $100,000 gain, I might go ahead and invest $100,000 into a syndication, and a syndication that's going to run a cost seg, that's going to take 100% bonus depreciation. And I can probably count on anywhere between $85,000 to $95,000 of my 100K investment coming back to me on a K1 as a passive loss, therefore offsetting the gain on the rental property that I'm selling. So it's really important, especially if you do have rental property that you're thinking about liquidating. Now is a really hot time in the market. Prices are high. There's a lot of built-in appreciation that at least our clients are looking at potentially taking off the table, cashing out. And one of the things that we are looking at with them is, if I cash out of property A and I've got this big gain, can I invest in a syndication that's running a cost seg study, that's doing 100% bonus depreciation? And if I do that, what is the passive loss that's going to come back to me? Generally, it's really large. Almost all of your investment is what we have been seeing pretty much across the board. All right, if we jump to the next slide, I've got an example here for us. So just to kind of illustrate how this works, let's say that we buy a 200-unit multifamily property We purchased it for $10 million. The total equity raise was $3.5 million. So that means that our limited partners invested a combined $3.5 million. The syndication engages in a cost segregation study, and the first year depreciation expense is $3.2 million. Let's also assume that earnings before depreciation were $100,000. So in this example, we had positive earnings of $100,000, and then we had first year depreciation expense of $3.2 million. That results in a $3.1 million taxable loss. The way that syndications work is that they would then distribute that loss to their partners, to their limited partners that have positive capital accounts. So if the limited partners raise $3.5 million and we have a loss of $3.1 million, that means that that entire $3.1 million loss is going to the limited partners. So if you invested $100,000 into this deal, the loss, the passive loss that you would receive would be $88,571 in the first year. And again, this is investing in November, right? So this can even be a very good year-end tax strategy. If you find the right syndication and if they're doing the right things, you can create large amounts of passive losses. And those large amounts of passive losses can be utilized to offset your other income, either passive income, or if you have positioned your facts and circumstances appropriately, you can even offset your ordinary income. But that is going to be a little bit of a deeper discussion there.
Hey, Brandon, can you touch on the positive capital accounts? Would there be a situation where there would be investors with a negative and others with a positive?
Sure thing. So limited partners generally cannot have a negative capital account. So if I'm a limited partner in a deal, I get a positive capital account for whatever cash I've invested. So if I invest 100K, my capital account equals positive $100,000. If I get a loss allocated to me, my capital account decreases with that loss. If I get distributions, my capital account decreases with those distributions. Limited partners cannot have their capital accounts drop below $0. So $0 is that threshold. If my capital account does drop below $0 and I receive a distribution, then that distribution can be taxable. So you do have to watch out for that.
This is Gary. I was able to invest in a deal at the end of December, and it was great because I got a K1 with a $61,000 loss from a $100,000 investment that I was able to use against capital gains on something else. So, I had a 22,000 plus tax savings from a late December investment, which was fantastic.
And that was not planned, folks. I promise. That's awesome, Gary. Congratulations, man. It's like living proof. We've had so many of our clients invest in these deals like late in the year. And it's great because early in the year, they're moving assets around. They're liquidating property. They're, just going about their lives. And you get to October, November, and they're like, okay, what do I do with this 200K capital gain? Well, this is one of many strategies that you can potentially tap into. You find a syndicate that's running a cost seg study, that's running 100% bonus depreciation, and you make that investment, and you're looking at a really solid chunk of your investment coming back to you as a passive loss. All right, so can you use the loss? As we've already kind of talked about, you have to have a positive capital account. So if your capital account goes below $0, you are cut off essentially at that point. You have to have passive income, right? So we already talked about the passive activity loss limitations. If you don't have passive income, you are subject to the passive activity loss limitations, and then you're limited to that $25,000 annual loss allowance. As long as your MAGI is below $100,000. If you're investing in syndication, your MAGI is probably above $150,000. So in general, that second bullet point, if you don't have passive income, you just can't take the passive losses. The big or here, or I guess unless, is if you qualify as a real estate professional and you make the aggregation election under IRC section 469C7A. This is something that not a lot of folks know about. A lot of folks know about the real estate professional status. You work 750 hours and greater than half of your time in a real estate trade or business. Less folks know that you also have to materially participate in your real estate activities. So, we will have new clients every once in a while that will say, yeah, I've been a real estate professional for years and I've been deducting all of the losses created from my limited partnership investments. And you can't do that 9 times out of 10 unless you can only, so qualifying as a real estate professional is step 1 to classifying my passive losses as non-passive. And what I have to do is step 2, I also have to demonstrate that I materially participated in my rental real estate activities in order to classify that passive loss as non-passive. When I classify that passive loss as non-passive, that non-passive loss can then be used to offset my earned income. So my W-2 income, my spouse's W-2 income, my business income, my spouse's business income, as long as I can qualify as a real estate professional and demonstrate material participation in my rental real estate activities, then I have the non-passive loss. But the problem is that you cannot materially participate in a limited partnership investment. There's no way to do it. You have no voting rights. You don't make any management decisions. You sit back, you collect the checks, and you review the financial statements. So this creates a problem, especially if you have been claiming real estate professional status and you've been claiming that you've materially participated in the limited partnership investments. Don't make that mistake. But what we do to get around it is we say, build out your own real estate portfolio. So if I'm an investor in a bunch of limited partnership deals and all these limited partnership deals are creating passive losses, I cannot say that I'm a real estate professional and I materially participate in all of those limited partnership deals. I just can't do it because I don't do it. But what I can do is build out my own real estate portfolio. I can buy 5 or 10 of my own properties. I can qualify as a real estate professional and materially participate in my own rentals. And then what I can do is make an aggregation election under IRC section 469C7A. And I can essentially group in all of my limited partnership investments as well. And so then all of a sudden, all of my limited partnership investments that create these passive losses also qualify as that material participation. And now I'll have a bunch of non-passive losses that I can utilize against my ordinary income or my spouse's ordinary income. So it's really something to just kind of understand that if you are investing in limited partnership deals and you are not a real estate professional, then you can kind of disregard everything I just said because you're not going to be able to take the passive losses unless you have passive income or unless your modified adjusted gross income is below 150. But if you are a real estate professional, then you have the question of how can I show that I materially participate in my rental real estate activities? You're not going to be able to do that with your limited partnership investments. So the solution is to group my limited partnership investments with my other real estate activities that I do materially participate in. And now all of a sudden I can claim all of my passive losses from the limited partnership investments against my ordinary income.
Brandon, if I can interject.
Sure.
So what happens? I love all these losses, bonus depreciation, cost seg. What happens when they sell the property? Am I going to get hit super hard? What happens at that time?
Yeah, it depends on the timing. But a lot of folks don't remember or forget about the depreciation recapture tax. So you will be allocated what they call Section 1250 unrecaptured gain, and you will have to pay tax on that Section 1250 unrecaptured gain, generally at a rate of 25%, potentially less depending on your tax bracket. So you have that to worry about. You also have long-term capital gains to worry about. Most of our clients, while it's definitely a planning item, it's generally kind of a smaller planning item just because there are so many other things that you can do to eliminate that gain, right? So if I'm a limited partner and one of the deals liquidates earlier than expected, and I have this big gain consisting of long-term capital gain and then also Section 1250 recapture, which is depreciation recapture, I can utilize the same sort of method that we've been talking about. I can invest in November or December in a new syndication deal and get a lot of passive loss to offset that gain. I could also now, thanks to the Tax Cuts and Jobs Act, I can also now invest in opportunity funds, and I only have to invest the gain portion, though depreciation recapture doesn't count. You can't roll that into opportunity funds. So it's definitely something to keep in the back of your mind. It's definitely something to plan for, but just know that there are many ways to get around it. It just requires some upfront planning. Good question. All right, 20% pass-through deduction. So again, we're going over just different ways that you as a limited partner can be receiving tax benefits, right? I don't expect you guys to walk out of here going, oh, wow, I'm a brilliant tax professional now. But I do want you guys to just be able to notate some of this stuff and then ask the sponsors of the deals that you're investing in, how are you planning on utilizing cost segregation studies? Are you planning on claiming 100% bonus depreciation? How are you planning on using the QBI deduction, the Section 199A, the 20% pass-through deduction that goes by so many different names? How are you planning to use these things to benefit me as a limited partner in your deal? I have the money, and you need to tell me why it's worth my time to invest in this deal. Now, they can't give you tax advice, but you can always take what they say back to your CPA, or if you're a DIY person, you can do it yourself, run a little tax estimate, and figure out exactly how investing in these deals is going to affect you from a tax perspective. So the 20% pass-through deduction, it's sitting in code section 199A. I don't know why I'm stumbling over that. Sorry. But basically what we have going on here is if your taxable income, this is your personal taxable income, is less than 157K if you're single, 315K if you're married, then any qualified trader business income that you receive, any QBI income that you receive can qualify for this 20% pass-through deduction. It's completely phased out if your income exceeds 207K and 415K if you're married. But when you are phased out, there are phase-out rules. I call them the limitation calculations, and that's what I've got there on the bullet point number 3. So when you're phased out, we're looking at the 20% of QBI or the greater of 50% of the W-2 wages paid to all employees, the sum of 25% of the W-2 wages plus 2.5% of the cost of qualified property. That last bullet point, 2.5% of the cost of qualified property, is generally what you would be looking at as your deduction if you are phased out of the 20% number because your income is above 207.5 or 415K if you're married. So if that's the case, then what you'd be looking at is 2.5% of the cost basis of the qualified property. And you would be, don't forget to throw questions in the Q&A section there. I think that you can do that at any time. So definitely hit that up. It's at the bottom of your screen, or at least it's at the bottom of my screen. But anyway, so you'd be looking at 2.5% of the cost of the qualified property, and that would be your deduction, not the 20% deduction. Specified service trades or businesses, I'm not really going to go over that, but once you are over that phase out limitation of 207.5K or 415K and you're generating qualified business income from like a CPA firm like myself, you are out of luck. You cannot utilize the 20% deduction. You cannot utilize the 50%, the 25%, the 2.5%. It's all gone. Now, if we go to the next slide, qualified business income is going to be qualified items of income, gain, deduction, and loss from any qualified trade or business, including income from partnerships, S corporations, sole props, and certain trusts. It must be effectively connected with the conduct of a trade or business within the United States. And that's just more of the official verbiage there. We jump to the next slide. So does rental real estate count as qualified trade or business under Section 162? So here's the thing. In order to qualify under Section 199A for the 20% deduction, you have to qualify as a trade or business under Section 162. Again, I don't expect you guys to retain these sections or anything like that. That's not the point here. But the point is that if you see CPAs talking about this, if you see tax advisors talking about this, if you hear anything about it, I'm just hoping that it might jog your memory a little bit if we go over it now. Basically, if you invest in a syndication, if you invest in rentals by yourself, the rental income could potentially qualify as a trade or business under Section 162. The problem is that in the past, nobody really cared if rental income qualified as a trade or business specifically under Section 162, because you could still deduct all the expenses, you could still deduct depreciation. So it was never really challenged. There's not a whole bunch of court cases out there. And when these rules came out, the CPA community, at least in the real estate space, was kind of going a little berserk because we were trying to figure out, okay, where is any authority that points to whether or not investing in rental real estate is going to qualify as a trade or business and thus qualify for the 20% deduction. So The IRS released a safe harbor. It's notice 2019-07, allows rentals to qualify as a trade or business for the Section 199A deduction, the 20% pass-through deduction. If you meet these three tests, you have to have separate books and records. You have to spend 250 or more hours of rental services performed during the year. And then starting in 2019, you have to maintain time logs, which is super fun. Triple net lease properties and properties that you personally occupy and rent out cannot use the safe harbor. It doesn't mean that they can't qualify as a Section 162 trade or business. It just means that they cannot use the safe harbor to qualify as a Section 162 trade or business. Now, the key here that I want you to understand is that the syndication that you're investing in, they're going to meet all those tests. And then they're just going to pass that Section 199A deduction to you. So if we jump to the next slide, you'll see that every syndicate that we have seen and that we work with meets the definition of IRC Section 162 trade or business and meets those safe harbor rules.
Brandon, sorry,
go ahead.
I have a question about business interest limitations. Can you talk about that and how a syndicator should best go about that to make sure they're taking care of their passive investors?
Yeah, so the business interest limitations, I actually did not include it in these slides because it ended up not being as negative as we thought it was going to be based on some additional changes that were made to the code. So basically, business interest limitations significantly limit the amount of interest that you can take. And so a lot of real estate investors were starting to freak out because a huge portion of the operating costs is mortgage interest. The way that it works is if more than 35% of the entity is owned by limited partners and you produce passive losses, so more than 35% of the losses are sent to limited partners, which is almost every single syndicate that I'm aware of, you have a tax shelter. And tax shelters are subject to, in a roundabout way, the business interest limitations. So therefore, syndications, real estate funds are subject to the business interest limitations. Now, you can elect out of the business interest limitations as a real property trade or business. The problem with electing out of the business interest, the problem of electing out of the business interest limitations as a real property trade or business is that you can no longer qualify for 100% bonus depreciation for real property. But the key is for real property. So what we have come to realize is that syndicates and real estate funds can elect out of the business interest limitations and still run a cost seg study because the 5, 7, and 15-year property that we identify is not considered real property for federal tax purposes. Therefore, we can elect out of the business interest limitations and still run a cost seg study and qualify for 100% bonus depreciation. So it's more of a compliance matter at this point, making sure that your CPA is following those steps, or at least the syndicate's CPA is following those steps. You as an LP, you can see this information on your K1s that are distributed to you. You can kind of see what they're doing. Typically, there will be a statement that says this entity has elected out as a real property trade or business of the business interest limitations under Section 163J. So, look for that if you are a limited partner. But other than that, should be relatively okay going forward. So what is the 20% pass-through deduction mean for limited partners? This is what I want everybody here to understand. If you're investing in syndications and you're a limited partner, this is the slide for you related to the 20% pass-through deduction. So just to recap, the 20% pass-through deduction allows us to deduct 20% of our business income or qualified business income. Syndications can do that. If the syndication has positive taxable business income, right? Positive taxable business income, not negative, positive, then you will qualify. You will be passed essentially a 20% pass-through deduction. You will see this on box 17 or in box 17. It'll be code V through Z, one of those codes, and that'll be on your K1. If you have negative Section 199A income, then we have kind of a problem. If you have other businesses that are producing positive Section 199A income, you might have to aggregate the losses from your syndication. So my CPA firm, let's say I net $200,000 from my CPA firm. That is positive 199A income. That qualifies for a 20% deduction. I can get a $40,000 tax deduction if I don't do anything. All right, right? That's just from generating 200K net income in my CPA firm. On the flip side, if I then also go and invest in a syndication, and let's say I get a $100,000 passive loss passed to me, and that passive loss on that K1 shows it's Section 199A qualified. Now I have to aggregate that loss against my ordinary income, my business income, for purposes of Section 199A. Now my $40,000 deduction decreases to $20,000. So just be aware that positive or negative, you'll probably have to run some sort of calculation on your tax returns to figure out what is your net 199A income, so that you can understand what that 20% pass-through deduction is going to look like for you. But again, look at box 17, code V through Z. If you have a CPA, they should know how to do this. If you're using TurboTax or I don't know, one of the other softwares, they should also have the coding at this point in there to handle this type of stuff. You just want to make sure that it gets into your tax returns. And then that last bullet point is really, the last bullet point on that prior slide is just really key. The deduction amount is calculated on your personal tax returns. The syndication is not going to calculate the deduction amount for you. It's very individualized. They're just going to tell you how much of your allocated income or loss qualifies for the Section 199A income. All right. Investing with a retirement account. Many of our clients invest with their retirement accounts. They invest in a solo 401k or a self-directed IRA. And what you have to understand, and this is not going to be exhaustive because this stuff can get very hairy very quick, but I did just want to kind of give you some high-level understanding of how this works. So typically, 9 times out of 10, a solo 401k is going to be way more advantageous to invest in than an SD IRA. The reason is that solo 401ks are not subject to UDFI. Or sorry, they're not subject to UDFI, which means that they also avoid UBTI. And I'll talk about that in a second. But basically we have UDFI and we have UBTI. Everybody's aware of UBTI for the most part. It's called unrelated business taxable income. And that's the tax on the income that is unrelated to the exempt purpose of your retirement account. Rental income is excluded from UBTI. So then the question is, well, why is it such a big deal then if I invest in a syndication with my SDIRA or my solo 401k? If they're buying rental real estate and they're producing rents, then it shouldn't be that big of a deal, right? And that's where we have the problem of UDFI. So UDFI is unrelated debt financed income. If the property has debt, you have not QDFI, UDFI. That's a typo, I apologize. But the key is, and I did it again, solo 401ks are exempt from UDFI. So if I am going to invest in a syndication, I'm going to put $100,000 into a syndication. Let's say that they're going to get a loan that's 70% loan to value. That means that 70% of the income coming back to me could be taxable. It's UDFI income, and it could be subject to UBTI tax. But if I'm investing in a solo 401k, then I'm not exposed to that. So solo 401ks become much more advantageous when you're investing in rental real estate. We jump to the next slide. We've got some filing requirements for your retirement accounts. So SDIRAs need to file Form 990T if you have more than $1,000 of gross income subject to UBTI. It's your responsibility to ensure you file Form 990T, and that is very key. We have seen a lot of syndicates, a lot of funds not report to their investors what they need to know for UBTI. You're supposed to report on the K1s, what the UBTI or the UDFI amounts were, so that the investors can then take that information and report on their own tax returns. So just understand that if you are investing through your self-directed IRA or you are investing through your solo 401k, it is on you to figure out what those filing requirements are. If you're investing in the solo 401k, you probably need to file Form 5500 EZ, and that's a requirement if your assets exceed $250,000. But again, you're less likely to be subject to what I refer to as this compliance black hole when you're investing in syndications through your solo 401ks rather than self-directed IRAs. They're a little bit more straightforward.
Brandon, can the cost segregation or the bonus depreciation help people who invest in self-directed IRAs as far as the UBIT tax?
Yes, it can. And so part of what we do too, whenever we have a client that's investing through a retirement account, is we're going to look at, even though we don't have $1,000 worth of gross income or income, and even if we're not subject to filing Form 990T, we're still going to look at potentially filing Form 990T, especially in years where we've run a bonus depreciation, or we have a big loss that's passed to us, because what'll happen is it'll capture that loss, and that loss can be used against future income that's generated, future UBTI, future UDFI income that's generated. So even if you have a loss, even if you're not technically required to file Form 990T, you still might want to explore filing it just to tell the IRS, hey, I've got this big loss. So in the future, when I have UBTI income, I can use that loss to offset it. So yeah, still beneficial to run cost seg and bonus depreciation, even if you are investing in a SDIRA or solo 401k.
Perfect.
Brendan, so I know a QRP, a solo 401k is a QRP, correct? I've heard lots of good things about it, but I think a lot of people have some confusion regarding that.
Yes. So QRP is a qualified retirement plan, and all that means is a 401k. So you can put solo in front of it or not, but marketers like to call it a QRP to kind of sound a little cooler than what everybody else is talking about, which is solo 401ks. Just be aware of that. But yeah, it's all the same thing.
All right, cool. So we do have some questions here, Brandon, that I'll go ahead and ask.
Sure.
Someone said, curious about advantages, disadvantages of the Delaware Statutory Trust for those wanting to defer capital gains.
I mean, the advantages is that it's another vehicle that you can invest in. The disadvantage is that, to my understanding, it's a rather long time horizon. So it's just, I believe that the admin costs can get pretty high as well. So there's always trade-offs, right? Typically, so we've had a few clients invest in DSTs successfully, but it wasn't until we explored literally every other option.
Okay. Why would a sponsor not utilize the cost segregation immediately?
Probably because I would say one of two things. I would say they got an analysis done and the analysis was subpar, right? So these cost seg firms will always provide you with generally a free analysis of what you can expect. So they looked at that and they said, you know what, it's just not worth the cost of engaging. But it would have to be like really subpar, like 10% of the cost is being allocated to 5, 7, and 15-year property. The second reason for not doing it is just either not having good advisors or not being educated of how you can pass the benefits back to your investors as quickly as possible. Especially with 100% bonus depreciation now, I've not yet seen a case, and we've been doing this since the beginning of 2018 now. I've not seen a case where not running a cost seg study on a property 500K plus, and this goes for your individual investments as well, where not running a cost seg study doesn't make sense. So I would say run a cost seg study. The net present value of the tax savings will generally always exceed the fees, will exceed the future tax payments that you're going to have to make. So yeah, there should not be a reason to not run a cost seg study.
Okay. And I think you answered this one, but assuming none of these tips are applicable to investing with a self-directed IRA. So we did talk about the benefits of investing with a self-directed IRA. So Maud, if he didn't answer your question, if you can type in kind of what you're looking for there. Someone else asked, I don't have rentals, but I carry seller finance notes. Does that qualify? And I think they're talking about the 20% deduction.
Yeah, it depends on how many notes you have. It depends on if you can demonstrate that your note business rises to the level of a trader business under Section 162. We have a couple of clients that have enough notes and do it enough that they do rise to the level of a trader business. But I would say in general, your note investing will not qualify for the section or for the 20% pass-through deduction. And yeah, you should just take that into account.
Okay, and I'm guessing wholesaling is the same thing, right?
Wholesaling will count. Wholesaling, you generate earned income, not interest income. So
okay,
you will be good if you're a wholesaler. If you're a flipper developer, you'll be generating earned income, and that will be qualified business income.
Okay. Do most of your clients receive profit distributions on the final K1 that exceed the net tax exposure?
I've heard this question before. I think it depends. Generally, yes. So generally, the forced appreciation on the property will be in excess of the net taxable income or of the net tax that you pay on that net taxable income. but it is very case by case. And, if you're thinking about that, that's good. You should think about that multiple years in advance. And you should be, I don't know, just using a spreadsheet or whatever sort of analysis tool you're using to plan all of that out. Talk to the deal makers, talk to the sponsors, ask them about their plans, ask them what the value of the property is, or if they could peg a value, and keep up with them on an ongoing basis. Don't just invest your money and sit back and not touch base with them for, some of our clients years on end. Otherwise you might be surprised with that tax bill at the end of the day. But in general, we have seen that the liquidation is successful, and the capital passed back will cover the tax liability.
Okay. And then Mike asks, is that the same for solo 401ks? So he's asking about my question about the UBIT tax with the self-directed IRAs. Is it the same for solo 401ks?
Not really, because solo 401ks are not going to be subject to, 9 times out of 10, they're not going to be subject to UBIT taxes. So in general, there's not a lot to worry about there, except for that Form 5500 EZ, but that's based on plan assets. The only thing that I'll say about solo 401ks is if you're investing in businesses that generate ordinary income, that income might be UBTI income. So you might have to watch out if you're investing in like self-storage syndicates or funds. Sometimes they'll have the rental portion. They'll also have the ordinary income portion based just depending on the actual deal, what they're selling. So you just have to be careful. If you're investing in multifamily property, generally you're fine.
Okay. And Steve asked, would you recommend a cost segregation if you sell the property in the first 12 months?
Yeah, that's a tough one too. It really depends. If you buy it in January and you sell it in December of the same year, I would say no. If you are spanning multiple years, I would say that you have a really unique position, because I can buy a property like in 2019, but not actually file the 2019 tax return until October 15th, or well, I guess if we're talking about a syndication, I don't have to file that tax return until September 15th, 2020. So I could wait, even if I've liquidated the property, I could wait until September 15th, 2020 to run a cost segregation study on a property that I bought in 2019, but I no longer own, just depending on how my income is shaking out. So it really depends.
Okay, very cool. All right, that looks like all the questions. So thank you for that. Brandon, maybe at the beginning we should have done this, but maybe you can share a little bit about your company and what you guys currently do. We didn't go over that very well, so want to give you the opportunity to do that here.
Yeah, that's probably my bad. I was, and I apologize to everybody for being a couple minutes late. I was trying to jump into Zoom here, which I use literally every single day with my clients. I couldn't figure it out. I'm like, oh my gosh, this is not my day. I run the real estate CPA, and we have 13 employees across the United States. We are 100% virtual, so there's no central office. Everybody works out of their homes. We've got employees in California, New York City, on the East Coast, Midwest. We only work in the real estate space, so we only work with clients that are in real estate. They're either running syndications or funds, or they're investing in rental property, or they're investing in syndications and funds. Those are the only clients that we really work with, and sometimes developers and flippers and all that. But we have about 400 clients nationwide, and we range from our smallest client being a woman that owns one rental property, and our largest client being, newest client being a team that owns $1 billion worth of assets. So we can definitely manage a lot of scale. Most of our employees invest in real estate themselves. I invest in real estate. I also have a capital group that we raise capital and invest in syndication. So we love the space, and we love providing tax advice and accounting advice to help make everybody's lives easier and build wealth in this space.
Perfect.
Is that a good late intro?
Awesome. Okay, cool. Lastly, everyone, we want to thank everyone for hopping on for sure and spending the last hour with us. Gary and I are going to be doing these webinars on a monthly basis now, and wanted to tell you about our next one, which will be on August 26th, and it's how to underwrite multifamily deals. And we're bringing on an analyst firm. Their name is Bullpen, and they're going to provide us with one of their top analysts to basically take us through how to underwrite a multifamily deal and how they look at it and their thought process to it. So we'll be sending out the link to that to everyone who was on the call and who signed up for the call, but also look for it, on all the other mediums on Facebook and everything else. And Lastly, if anyone on here is interested in learning more about multifamily syndication and what our companies do, definitely please reach out to Gary and I, and we'd love to talk to you about it. So appreciate it. Hope everyone has a good night, and thanks for jumping on.
Thanks, Brandon. Thanks, everyone. Thanks, Kyle.
Absolutely. Thanks, guys, for having me. I appreciate it.